Forex. It's big. It's liquid. It's the ocean of the financial markets. Trading on foreign exchanges using currency pairs? What's the trick? Margin and leverage, reward and risk. We'll see how it all ties together. Hello traders, I'm Simon with FXEmpire, and welcome to your first step of your Forex journey. In this 6-part series, we will take you through the basics of trading Forex. We'll discuss the mistakes new traders should learn to avoid and the psychology of trading. We'll talk about the ways to get exposure to the FX market and understand what are CFDs. As a final part of the series, we will share our expert tips on picking a safe Forex broker. In this video, I'm going to answer some fundamental questions, like what is the Forex market? Why is it a great market to trade? What is a currency pair, and how do I read it? And what are the major terms and concepts that Forex traders need to learn? Before we get into it, if you want to learn more about Forex and trading, don't forget to subscribe. Forex trading can be an exciting, lucrative, but tough activity, especially for beginners. New traders always underestimate the importance of financial education, lack risk management skills, tend to have unrealistic expectations, fail to control their emotions, and don't have one of the most important skills it takes to be a trader: knowing how to accept loss. Traders in all markets have to accept losses because even the best strategies only work part of the time. So, what is the Forex market? The foreign exchange market, aka Forex, aka the FX market, is a global decentralized market where the world's money is exchanged through the buying and selling of different currencies. All traders go through brokerages, over-the-counter OTC markets, or an interbank system, so you can forget about centralized exchanges. Millions trade Forex, from the average Joe retail trader through to the slick Rick Wall Street cat. The market is full of funds, institutions, central banks, commercial banks, and a whole load of other organizations looking for their share of the Forex pie. And it's no surprise, it's one tasty pie. In fact, it's the world's tastiest, most liquid market. Why is this, though? Well, it's a huge market with trillions of dollars traded daily. Traders have 24-hour access, 5 days a week, between Monday and Friday. There's a wide variety of currencies and currency pairs to trade. It's a market known for all levels of volatility, from quiet price action to historic uptrends and downtrends. It's ideal for traders of many tastes. It's a market with a low entry level, meaning you can open an account with a low investment. As well as low minimum investments, it also has pretty low transaction costs, meaning stuff like commission, spreads, fees, and interest are all relatively affordable. Now we know why it's the most popular girl in school. Let's take a look at how it works. Forex trading works using cash-based spot markets and derivatives markets, which provide access to forwards, futures, options, and currency swaps. Retail traders generally trade Forex to speculate on higher or lower prices, making a profit or loss on each closed position. While institutional Forex activity normally gears itself towards hedging bets against currencies and interest rates, or looking to create diverse portfolios. New traders open accounts with Forex or CFD, contracts for difference brokers, taking exposure when trading currency pairs, like the Euro-US dollar pair, or US dollar-Japanese yen pair. What usually happens is a trader, so you, will open a buy or sell, also known as a short, position, and bag a profit or take a loss based on the difference between the opening and closing price. Simple enough, right? So what's exposure then? Well, exposure at a CFD broker is taken between the trader and broker, establishing a legal obligation to exchange the difference between the entry and exit price of the asset, meaning you gotta pay them what you owe, and they gotta pay you what they owe. Groovy. An asset in this case is a currency pair, but can include stocks, bonds, futures, and any other financial instrument. So what moves the Forex market? Many factors move the Forex market on a daily basis. Forex traders usually keep 24-hour economic calendars close at hand and keep an eye out for regularly scheduled data releases. These data releases usually create the majority of currency pair rallies and declines, as any numbers which fall outside of projections tend to get people pretty excited. It's not just numbers, though. Global shock events like political, elections, wars, economic disasters, even natural disasters move Forex and can create some pretty volatile price action. But how can we take advantage of this price action if we can't read a quote? Foreign exchange is always quoted in pairs. For example, in the euro-US dollar pair, the euro is the base currency while the US dollar is the quoted currency. The quoted currency is always the equivalent of one of the base currency. So if the euro-US dollar exchange rate is at 1.1222, you'll get $1.12 for 1 euro. Note how the euro-USD pair has 4 decimals. This is typical of most currency pairs, except those including the Japanese yen, which display only 2 decimals. When a currency pair moves up or down, the change is measured in pips, which is a 1-digit movement in the last decimal of a currency pair. So, for example, when the euro-US dollar rallies from 1.1222 up to 1.1223, the euro-USD pair has increased by 1 pip. You'll usually see 2 prices in a currency pair quotation, a sell or bid price on the left, and a buy or ask price on the right. The difference between these, the price, is called the spread. Spreads are basically fees and are pocketed by the broker. A buy order that's filled above the quoted ask or a sell order that's filled below the quoted bid incurs slippage, one of the biggest obstacles to profitable forex trading. Slippage mainly occurs in volatile or active currency pairs when placing a market order, when a buy order is filled above the quoted ask or a sell order is filled below the quoted bid. Slippage occurs. This tends to happen during higher stages of liquidity, and since the average daily trading volume of the forex market now exceeds $5 trillion, it could happen quite a lot. The concept of liquidity works hand in hand with volatility, which measures the speed and velocity of market movements. The majority of forex traders love volatile markets because they provide greater opportunities to profit, especially with short-term strategies like scalping and day trading. I will cover it in our next video. Now, wherever there's huge potential for profit, there's huge potential for loss. Most forex traders lose money. A lack of preparation, bad leveraging, weak skill sets, and emotional fatigue all work towards making a trader make those mistakes and taking those painful losses. The ones who profit are the ones who spend hours building skill sets, doing research, and testing new systems and strategies. Some major risk for the typical newcomer are market manipulation by big banks, growing too complacent, failing to place stop losses, or taking too much short-term exposure for their experience level. A new trader's biggest risk, however, comes from the broker they choose. There's a whole load of unregulated brokers. They're pretty easy to spot if you know what you're looking for, though. They'll be based in offshore tax havens rather than heavily regulated zones like the US, UK, EU, or Australia. Unregulated brokers do the most damage when they operate a dealing desk that takes the other side of a customer's position, that manipulates prices by requoting to trigger stop losses, forcing positions to close and capital lost. This ruse tends to happen when traders are asleep too, meaning it can be super difficult to know what happened. And at the end of the day, they're unregulated. So who's going to stop them? The forex market has grown hugely popular with new traders and has never been easier to access. Learning the basics of forex trading isn't overly complicated, but is essential if you're serious about making profits and not in a position to lose all your money. Finding a way to trade that suits you requires self-examination with a realistic view of your personality traits, available time, long-term goals, and current income. It's a rewarding endeavor if you have the dedication, patience, emotional control, and a willingness to build your skills and become a forex trader. Whether you then go pro or just keep in retail is your choice. Thanks for sticking around. I really hope you learned some solid need-to-know fundamentals for the forex world. Learn anything new or think we missed something? Leave a comment to let us know. Oh yeah, and don't forget to subscribe and drop a like if you want to see more content that'll help you on your forex journey. See you in part 2. Stay strong out there, traders.